We've made tons of videos now about Roth IRAs and Roth 401ks, but we've taken one question for granted that we should probably address now. In our videos, we've raved about Roth accounts and how they're such a great investment vehicle because of their tax advantage savings and their ability to grow through compounding interest. But that's a little deceiving because just like a garden can't really grow without any plants in it, a Roth IRA or Roth 401k can't grow without any assets in it. In this video, we'll go into greater detail about the difference between a Roth account and the assets that go inside of it. Starting from square one, a Roth IRA is simply an account that holds assets selected by the account owner. The investments are what could potentially cause the balance of the Roth account to increase. Now, for reasons we won't dig into in this post, financial jargon and vocabulary can be very confusing at times. And adding to that confusion are knuckleheads like me writing posts and making videos about financial topics, while also making broad assumptions about how well versed our readers are on the lingo. In fact, we overlook some very fundamental concepts in our quest to untangle more complicated issues for our readers. For example, any investor should understand some basic differences between things like IRAs, 401ks, mutual funds, ETFs, bonds. But in this bag of financial jargon and terminology are two fundamental categories. We want to highlight and explain each of those categories in this video. And understanding the primary difference between these two categories is a fundamental piece of having investment success. So to begin with, let's answer the question in our title. How does my money grow in a Roth IRA? And the most basic answer is through investment return. And your Roth IRA will grow by selecting an investment, or better yet, a pool of investments that will increase in value over time. These investments could be things like stocks, bonds, mutual funds, ETFs, treasuries, CDs, money markets. There's really no end to the number of investment products you could potentially put into an IRA. Now, we have more detailed posts about these investment types on our website at markmoney.com. We'll put a link to some of those in the description below. But summarizing here, all of these investments gain or lose value based on market forces. So in the case of stocks, mutual funds, ETFs that own equities, the value of those is determined by the market value of the underlying securities held in those types of accounts or in stocks and the value of the business that it represents. Meanwhile, bonds, CDs, money markets, and treasuries are all debt instruments. This means you act as a lender when you buy those securities. Now, debt investments have more stable returns, but they're not completely without risk. Now, treasuries are backed by the full faith and security of the American government, so they're about as close to a no-risk investment as you can possibly get. For the sake of explaining the difference between these securities and other financial items, we'll metaphorically call securities contents and we'll call accounts containers. Now, anyone can purchase the securities we just mentioned, but there are a lot of different ways to own them. And the reason there are multiple paths to the ownership of securities is because different account types have different tax treatment. This is what we're going to call our containers. And so 401ks, 457s, 403bs, IRAs, these are all versions of containers. Another way to think of it is like a house. The house would be like the IRA, the 401k. The furnishings are the securities that go in it. Hey, we hope this video is helpful to you. If it is, if you could please click the like and subscribe buttons below. It's a huge help to us. It helps our channel to grow, helps get the word out about what we're doing, helps us teach other people about personal finance. Now, there are three basic account or container types. The first is taxable. The taxable accounts are containers that are funded with after-tax dollars, meaning that you paid income tax or some sort of tax on the money that you put into the account. Furthermore, any growth in value or earnings you earn from that savings is subject to a capital gains tax. And basically, every dollar that goes in and comes out is subject to tax. Now, inside a taxable account, which usually you'd use a brokerage account, you can own any security just like you could an IRA or 401k. And a lot of times you'll open these with companies like Vanguard, Fidelity, Charles Schwab, or any other investment company. The second type of container is tax deferred. These are things like traditional 401ks or traditional IRAs, where the tax is not withheld from contributions, or you get a deduction when you make a contribution, but you pay tax when you make a withdrawal. And the tax benefit of tax deferred accounts is that the earnings are allowed to grow completely tax-free for years and years and years, which really puts them in a great advantage. The third type of account is an after-tax account or a Roth account. These accounts are funded with dollars that have already been taxed. And the good news about that is the earnings and withdrawals are made completely tax-free. Once again, you can own nearly any security inside of an after-tax or Roth account. And again, to help you visualize the difference between accounts and assets or containers and contents, we've got a table on your screen. Hopefully if you have any other questions about what qualifies as which, this will help clear it up. So why do you need to know this? Well, first off, your account value won't grow any if you don't invest in something, so there's that. You also need to understand the tax implications of each account type. And the reason that's important is because different assets perform better in different accounts. So for example, municipal bonds are not subject to federal income tax. As a result, it makes sense to hold those in a taxable account. On the other hand, bond dividends are subject to tax. As a result, it makes sense to hold those in either an after-tax or tax-deferred account where they're sheltered from taxes. Also, many investors typically own more risky investments like stocks or stock-based securities inside of Roth accounts because that's typically where you're going to see the greatest amount of growth. And you might as well have it in a place that's never going to be subject to tax again. If you had to choose, you'd really want a Roth account to grow more than a taxable or tax-deferred account. So in summary, by just knowing the different tax treatment of each container and the contents, or the different tax treatment of a different account type and the assets, you can better optimize your portfolio to produce returns without taking on any additional risk. It's all based in the knowledge of how they work. Like we've already said, we've got tons more information about this on our website at martinmoney.com. We'll also provide a link to the written form of this video in the description below. You can also check us out on any of the social media channels on your screen. Again, we're always grateful for your interest in our videos. God bless and take care.